Okay, well, I worked feverishly on this list. You know, even radio shows, one thing, I always am very well prepared. I probably have twice as many questions as I ever need. And invariably, I listen to the answers, and it goes off to other tangents. And that's certainly what happened now. I found it very interesting. And Tommy, I need to find the notes that I had for you, because I just want to start. You had me read The World is Flat, the book that he does not like. It's okay.
I excuse him. He cannot help it. He'll get over it.
Well, there's some quotes that I'll just do one of them right now. No institution will go through fundamental changes unless it believes it is in deep trouble and needs to do something different to survive. And I really think that that's one of the core issues that I think you wanted me to read that book for.
Absolutely. I think that, and I've already mentioned that earlier. I think in America, and needless to say, you folks have heard me for a couple of 3 years by now, nobody believes in the free enterprise system and the opportunity that America affords. There isn't any place in the world that affords this opportunity, but it has been built upon the initiative of the individual. And the key thing we have to focus on is constantly turning that individual loose. And that's where I think the problem is, and I'm not wanting to hammer the government or anybody else, but anytime you put things in the way of that individual being able to buy the product, whatever the product is, for its fair market value at a given point in time, then there's going to be a repercussion eventually that is going to be far worse, in my opinion, than dealing with the value today. I think that naturally, I believe in the auction process. The stock market, and you've heard me say this before, the stock market is an auction. And everybody agrees with that auction each and every day. Now, there are many factors that make that auction work, but what if tomorrow morning the Dow Jones says, you know what? If Microsoft does not bring $25, we won't sell it. Wouldn't work. It won't work. And see, that's what's happened with us in this housing situation. 3 years ago, the market told us that we had to rethink what houses were worth. And unfortunately, we have found out how accurate the market was. And that's why I agree with Sean. I think Sean is dead on. I only wish that he was not as accurate as I'm afraid he is, because I think that we have a long road ahead of us before we reach what I call the real value that the average homeowner can afford to pay for a home in America. And there's going to be a lot of pain between here and there, but the quicker we let that happen. Now, I think that Sarah has this program where a particular city could buy homes, and maybe we've talked about that, maybe actually bulldoze 2,000 of them, because they're a detriment to the entire community. Not wanting to be hard on New Orleans, but if anybody has visited New Orleans, I can assure you, you could go down there and tomorrow morning we would all agree you could get rid of 10,000 homes and it would be the best thing that ever happened for that city. But nobody wants to tell it quite that straight.
Well, they just did.
Yeah, well, that's who I am.
One more quote from the book, and I enjoyed the book. I haven't read it all yet, but I read it for 3 hours today, that book. And this stuck out to me. Unfortunately, it's been too long since America had a leader ready and willing to call on our nation to do something hard, to give something up, not to get something more, and to sacrifice for a great national cause in the future rather than live for today.
Of course, I could not believe more in that philosophy. And I think any politician that would actually have the courage to stand up and tell America what is true, and I mean stand by now, don't ever give it lip service, but to say to America, this is what we must do. I think you would be flabbergasted how America would get behind that person and elect them instantly. But we've had so much BS, we're not used to it.
When I opened the questions and asked you the first question, that was, a crisis is a terrible thing to waste. We've had two in the last decade, 9/11 and this financial crisis. And I remember being in a baseball game where 50,000 people stood up and sang the national anthem. And I've been to baseball games way before that, and if 2 people stood up, they were shy. And one time, 50,000 people and a fighter jet went over, and that was a touching moment. I think that's the type of thing that when you have a crisis, you can make some changes and get some support. But yeah, we really have to have somebody that we believe at the top, that's for sure. Christopher, you had mentioned, and this is a connection with that quote that I just read, you seem more concerned about our debt levels than our fiscal. Would that be accurate? Our debt levels as far as, well, let's talk about...
I'm worried where our fiscal debt is going. Where it is right now is fine, but the trajectory we're on is terrifying. Okay. I mean, we're borrowing $1.3 trillion this current fiscal year. We really don't have a lot of debt because much of the debt is sitting in Social Security, and so net debt is maybe 60%, 40, 55% of the economy right now, which I know sounds high, but it's really not that high. It's certainly not large from a industrial country perspective. But if you're borrowing $1.3 trillion a year, that's going to turn from 55, 60% to 90% to 95 to 110% in the very near future. And since we are a nation, unlike Japan, we are a nation that relies on external capital. There's going to come a point in time where the world bond market is going to say enough is enough, and then it's going to be very, very difficult.
That's just at the federal level. I mean, what about households, cities, counties, states?
No, they're not that bad. The day is there. And first of all, don't forget, most states and counties are limited in their ability to hold debt. They don't have, we have a deficit, but we don't have a state debt problem outside the pensions, which is...
Right.
We can, I can already see it already. We survived the pensions crisis 2025 cancer charity event, all right? So that'll be the next round, but that's not what we're talking about today. And consumer debt really, went up. It spiked up largely along with asset values. In fact, you look at the level of American debt, it stayed proportionate to asset values in the midst of this massive asset bubble.
About 10.
And the problem is when the asset bubble went away and asset prices are back to normal levels, suddenly Americans realized they had too much debt. And by the way, the vast majority of that is mortgage debt. Non-mortgage debt didn't rise at all relative to GDP through this crisis. It's been in the same trajectory. It's mostly mortgage debt. No, by the way, it's mostly Fannie and Freddie mortgage debt, along with some asset-backed securities. And so, but overall, that hole is not as large as you might think it is. It really isn't.
It's GDP manufactured through finance, insurance, and real estate, right? So is it real GDP? It's not like we're manufacturing.
Oh, I don't want to get into debate with you on how you measure GDP. That's completely irrelevant. Let's just say it's believable enough.
Well, but let's talk about the future growth then, because the 90s that GDP growth came from a lot of stock investments, yes?
No. Stock investments have nothing to do with GDP. Don't confuse the real world with the financial world. Okay. All right? The real world
when we spend stock profits, is that part of GDP?
No.
No. Okay.
No.
Okay. No, I
separate issues.
Okay.
In fact, that's one of the goofy things about it, because what they have to do is you pay taxes. Let's say you make capital gains in your stock market portfolio. You will pay taxes on that, and it will be recorded in the GDP statistics as taxes paid. But they have to subtract out your capital gains income from the personal income account.
Okay.
Because that's not included in there. So it becomes this goofy game. That's just why taxes are so hyper-cyclical. A lot of it is the fact that there are non-recorded income in our personal income statement.
You said there's some point you are worried about our fiscal debt. And
I'm worried about it now.
You're worried about it now, okay.
Yeah, because of where we're going with it.
What percentage do you finally get concerned? I mean, is it 100% of?
You know what? That is an unanswerable question, because we've never been there before.
We haven't, but
we've never been there before, and we've never had a government that on both sides of the aisle seems absolutely so unbelievably unwilling to acknowledge the reality of the situation. Neither side. I mean, we can't raise taxes, but you have to close the deficit. It doesn't work that way. This is what the scary thing is. I am a proponent of raising taxes.
A proponent?
I am.
Okay.
And I think that the entire Bush tax cut should be rolled out over the next 2 years. Not because I like paying taxes, but because if you finally make the American public pay what those guys are spending, then we will finally stop them from spending it. And that's the problem. We have developed this shocking ability to pretend that somehow the federal debt's not our debt. It is our debt. If they're borrowing $1.3 trillion, a lot of that's yours, folks. I mean, that's a lot of money.
Yeah.
That's $4,000, $4,500 a person. And, oh, by the way, the vast majority of Americans are not going to be paying that.
Right. Everybody's got to pay taxes for it to make a dent, for them to
Yeah.
come to the realization that it's a problem.
That's a problem, exactly.
You have-
And so the
You
entire
have more
taxing...
faith than I do, they won't spend it.
What's that?
You have more faith than I do, they won't spend
Well,
the
at
additional
least at
taxes.
that point in time, people will be forced to acknowledge the reality of the situation, because right now we live in this never-never land where somehow or other it's not a problem.
Do you feel that deleveraging is deflationary?
No.
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 Okay.
Because leveraging is not inflationary.
Okay.
We went through a huge period of leveraging, and I didn't see any sign of inflation anywhere across. In the middle of that leveraging binge, Alan Greenspan was worried about deflation. So why in God's green earth would everybody think that deleveraging is going to lead to deflation?
Okay. Well, that's why I'm asking. When you
Yeah.
pay things off instead of spend, that's not affecting it?
You can reduce demand somewhat, and that can reduce what we call the velocity of money, which can have some deflationary pressures, which is exactly why Bernanke went through quantitative easing to pump money in the system to offset that, by which he did a pretty good job.
Okay. All right. I have to
Still don't
reread-
believe me.
I've got to read that book. No, it's okay. No, it's just it's a tough subject. And that's one of the things, I don't have a background in some things to where concepts, they're not second nature. And that's the thing. You read a lot, but there's some things that are just missing. You really have to try to get them. Joseph, I wanted to ask you something, because it occurred to me in the real estate bubble about the definition of market value. And the definition of market value, if you have a willing buyer and seller who come to a meeting of the minds, then you have a comp. And it occurred to me that definition will never be able to stop a real estate bubble. Because we built homes in, let's say, Rosamond. And in Rosamond, the market should have been probably 150 grand, and we were selling for 280, and people were camping out. And the evidence was there that was worth 280 because we had 10 people want one. And the reason I bring it up, in the commercial world, the appraisal has multiple pieces. And it's on the residential form. You have comps, you have cost of building, and you have income generated. But in the residential world, thus far, it doesn't apply. I guess I'm just wondering, do you see any pressure to change the basic structure of how you come to a value?
Well, I think that definition needs to be looked at, because if we look at what happened with pricing, especially here in California, the prices escalated so fast, they showed us on the chart, yet the rentals that we were able to get residentially didn't change that much. And so I think what happened is, I think the prices changed a lot, but the underlying value didn't go up that much, and we're coming back down to that level. And unfortunately, the government created too much artificial demand in the housing market, and that helped cause this bubble, that taking people basically really couldn't afford to have a home, and coming up with programs to put people in housing. So that definition needs to be looked at, and we're having some people look at it today, and we're discussing with Representative Konjorsky, again, some problems in the housing market now that we're talking about. But fundamentally, if you have a willing buyer and a willing seller, but what they need is they need that debt. And when they make debt so affordable, then people are going to do it. It's no different than a developer. If you give them money, people would be building homes out here like mad.
That's right. I think the reason I brought up the question is honestly, all industries they're not independently capable of protecting the system. So an appraiser coming up with an appraisal, if there's not a backstop of a lender saying, well, that person can't really afford that payment, then you do have the tendency to skew off to where we went in 05 and 06.
Well, one of the things we teach, and it applies more on the commercial side than residential, but it should be looked at for residential, is financial feasibility of a property to perform. And when you look at that rent, so the people may be paying this price of $400,000 for the housing today, But if a lender had to take that property and lease it in the market and see how much debt it could cover, our loan ratios are much too high. When we have escalating prices, we need to consider lowering the loan ratio. And unless we do that, we're going to keep in the same loop and have the same problems. So fundamentally, one of the things I'm suggesting is maybe we should be reporting two things. Number one, this is what the market is paying for housing, but this is what things are renting for. And so you can see that debt level, and you can say, you know what, that market price isn't going to escalate as fast unless the government makes artificial money available. And I just refinanced my home, I told you yesterday before I came out, for 3.9%, down from 6.2. And Bruce and I were kind of laughing because we had bought some property about the same time. I thought I got a great deal at a 14.5% 3-year ARM, and he got his at 17.5.
17.5 fixed in 1881.
We both would have bet at that time we would never see rates this low. In fact, you have the amortization charts that only go down to 4.5%.
Every intelligent person said there wasn't ever going to see rates under 10%.
So what I'm looking at is why not take the 3.9%?
That makes sense.
I mean, if somebody's silly enough to give me money that cheap, I'm smart enough to borrow it. So,
Sean, we've never talked about it directly. What do you think of the nothing down loan idea?
I actually think that every single loan program that we had, pay option arms weren't originated here. Golden West originated them back in the 80s as protection against changes in interest rate. Stated income loans, I think, are fine. Pay option arms, all of that, I think it's 100% financing, I think is fine, right? People walk away from their house once they get underwater, right, and they don't have an option. The only other reason for foreclosures is death, disease, divorce, denial, drugs, right? Those are going to be there. They're a base rate of foreclosure. They're always with us. The reason we have a high rate of foreclosure right now is because we let prices get divorced from incomes, right? And we didn't have the fundamental ability to pay. I was buying foreclosures in Stockton, and we didn't have any problems in Stockton until builders started to discount. And when the builder discounted, the guy that had the stated income, no doc, et cetera, loan, said, well, geez, I can now get the same house for $50,000 less with a swimming pool. I'm going to open a bud, drink it, walk from my house, right? And that started this whole thing. I had a house in escrow for $320,000 in Stockton, right? And a builder put up a sign, new homes, it was a 2-bedroom home, new homes, 3 bedrooms from the high 200s. My escrow fell apart, of course, right? I sold that house for $260,000. It's now worth probably $85,000. But here's the thing, it was always worth $85,000. How did we get from 19 months of inventory or whatever we hit at the peak in Stockton back down to 3? I mean, the neighborhood stabilization program, we're out of inventory. I mean, it's starting to creep back up now, but we were out of inventory. We needed some more houses. We don't need to give them to government. We don't need to waste taxpayer funds on that. We needed inventory. And we needed inventory because prices corrected back to a level people in those areas could afford. We had a massive price bubble that took prices out of where they should be for the incomes. And we're still there. I mean, government stimulus has created every housing bubble in our history, right? After we created FHA and the rest, we had a bubble in the 30s. We had the GI Bill that caused prices to go up in the 40s. If you pull out government stimulus, housing has been flat with inflation for as far back as you can look.
I don't think I agree with that.
Look at Case-Shiller's little
First of all,
chart.
Case-Shiller's numbers are completely goofy, particularly back in the 30s. His data has massive flaws, and nobody believes it in the economics community, okay? Not one
Every
person.
housing bubble
Secondly,
has been
the
immediately
bubble,
preceded
the bubble in real estate this time around was not driven by Fannie and Freddie. It was driven by the private lenders and the private subprime guys. The problem with Fannie and Freddie is they got on the boat late. But they didn't cause this. That's crazy to say they caused this.
I didn't say Fannie and Freddie did, right? I said changes by the government. It's specifically here, repealing Glass-Steagall and commodity futures. We allowed these lenders to go gamble with taxpayer money. And that made housing cheaper. And when you make make lending cheaper, you see an explosion in lending. Every time we go out to make homes more affordable for people, they don't get more affordable homes, they pay more for the same home. Because people pay a percentage of their income for housing. Price is just a function of income in loan terms. It always has been, always will be.
I agree with that.
Okay.
Yeah, that much I agree with, but the government didn't start this.
But every increase we've had in housing was
That's not
directly
true.
preceded by some effort to make homeownership more affordable.
That's completely not true.
I don't know what to do.
I would like, but don't you both agree that income definitely does dictate how much you can afford to pay for a house? Don't you both agree?
No, I agree with that. But somehow or other, you're blaming this on the government. And I think Goldman Sachs and all the Merrill Lynch and all those guys had a big role to play, and all those subprime. Don't tell me this was a government operation. Angelo Mazzillo had nothing to do with the government.
Well, actually, I think
Charles Prince had nothing to do with the
we should be looking at
government.
the chairman of Wells Fargo. I mean, he stood in front of the Commonwealth Club and basically said, look, I went in there and lobbied to get Glass-Steagall repealed and the rest so we could have all these financial innovations, yet he's still held up as a hero. I don't think Angelo Mazzillo was that smart, except he rode along at the right place in the right time.
He made more money
We
than those
created
guys
those
did.
opportunities.
Well,
I should have brought gloves and a headgear. Okay.
You want to get the headgear out?
Yeah, I think I got to do it.
I think that, that going back to, earlier, when Paulson came and said we shouldn't sell these assets into these distressed markets, right? The problem is this market's not distressed. These price levels aren't distressed. The only distress is that lenders lent way too much for what the market could afford.
Okay, now let's talk about how much, the shadow inventory that's not being foreclosed on, the delinquencies. What percentage of, let's say, LTV is the pile of that? Is that like 150% LTV at this point?
You mean in terms of the overall out there? I mean, I don't have those stats. I don't study that. I know CoreLogic looks at some of that.
Well, you just said something about 250 and 150 a while ago.
The average foreclosure by the time it hits the courthouse steps in California is $150,000 upside down.
Okay.
And it's now worth about $250,000. Right? So we have that data on every single property that crosses the courthouse
how much
steps.
of that $150K though is built up on legal fees and interest payments and service fees and all the other?
No, actually, we calculate it based on the original loan amount. So we're actually under-calculating it from that standpoint.
Understood.
And you look at some of the principal balance reduction programs, they come out with these big numbers, and they sound big in the press, right? Like the $6 billion you mentioned earlier for the NSP program. I mean, that's not 1 month worth of loans that get foreclosed in California. I mean, it's a trivial nothing amount in the big picture.
Right.
Right? So, and I think when you look at how big the losses are per house, and you look at the folks walking away, they're really making, the right decision. We just created way too much debt. We've got to clean it up.
Okay, if you ended up, let's say we end up foreclosing on a lot of houses, do we have capable buyers right now?
It's certainly in California. I don't know if that's true everywhere in the United States. I think you have different problems in different areas. I think there's some places where only a bulldozer will fix it because you've had net migration out. Yeah. But I think in California right now, we could bring forth most of these foreclosures, and I think you'd see most of them clear.
That's particularly true if you got the investor market more involved.
Absolutely.
Yeah, absolutely.
Because the investor market, I think, is an important component out here because there are a lot of families that would have a tough time, I think, making ends meet, getting a down payment and getting through the process, but they could pay rent. And I know a guy out here right now he's still picking up units here and there. He's getting them only one at a time, two at a time, but he gets them at a good price. He's making a cap rate 9, 10, and it's a nice business model for him. And he's hoping for more foreclosures to come out because that'll put him back in that 9, 10 cap rate, and he'll go out and buy 100 other things.
You know what? Investors are much better at this than the government too, right? So the trustee. At the trustee sales, we look at the properties that go back to third parties versus that go back to banks. Third parties, on average, right now, flip those properties in 130 days back to a homeowner, typically Fannie or Freddie financed, right? That's a productive homeowner. They've cleaned the house up, they've cleaned the neighborhood, they do it in 138 days. Takes the government 200 days.
Right, but and I don't disagree with that.
That's why a very small percentage are really going to the NSP, full renovation type of programs, because like you said, $6 billion doesn't go very far, and they're having a hard time spending it, frankly, because they're that poorly organized. Most of the properties are going in the hands of investors, that third that don't go to owner occupants. More would go to the investor that has the ability to do credit, rehab, and financing, and portfolio lending, and affordable mission things, but they're not willing to pay the same price that the individual investor is paying or that the owner-occupant is paying. So you as a taxpayer have to decide, would you rather me sell to a large bulk of homes to somebody who's doing a great missional thing but wants them at 70 cents on current market value, or sell them to an individual investor at 85% of current market value, or to an owner-occupant at 97% of current market value?
Haven't we done one other thing this cycle that we didn't do before? We've taken away the social stigma to foreclosure. Today, more so today than we've ever had.
That's because of the sheer quantity. It's kind of like a penguin theory, where they all jump off at the same time. It doesn't.
I understand, but this cycle,
yeah,
we've taken away the social stigma, and the guy who just says, well, gee, I can go down the street and get a house with a pool for $50,000 less. I'm just going to walk, because nobody's going to ding my credit, or I'm still going to be able to go to the country club. I'm still going to be able to do all these things. We've just taken the social stigma away. I don't know how much of that is in effect, but clearly this time over all the other cycles, that's there.
I think there's been studies done, and I'll get it back to you, Sean. There's been studies done that when you get past a certain point of equity, the rationalization process certainly gets intense, and if you hang around a lot of people that are making that decision, in other words, your circle has a lot of company, given the level of debt we have on houses, honestly, and the level of delinquencies we have, I got to tell you, I'm more impressed. I'm actually impressed with the character of the country, because we don't have a 50% delinquency rate. Because there's a lot of people seriously upside down making payments, and they got to know that they're years away from a break even, and they're still doing it because somewhere inside that's what they're supposed to do. So we have a great big default rate, but it's not what it could have been.
You got, according to CoreLogic, you got 11 million people, 11 million households underwater, and according to the MBA, you have how many delinquent loans? 6 million?
Less, right?
6 million, 6.5 million. So
Five.
yeah.
Five, somewhere there. Yeah.
So they're not too far off.
50-50?
Yeah, 50-50.
Okay.
Well, I mean, another way to look at this, it's 10% delinquent and 28% underwater, or near underwater.
Okay. I'm sorry, did I cut you off, or you?
No, I was just, at the end of the day, I think people want to be homeowners, and so long as they don't feel like they've lost value and they can afford the payment, I think they'll be homeowners. But, California, we have, on purchase money loans, they're non-recourse, right? Which says that the lender's now a partner with this homeowner when they buy this home. That if it loses value, the homeowner can walk away, right, without any recourse back to them other than a hit on their credit and having to move, right? And that's a pretty fair deal, right? Lenders should have a better picture of house prices and economics and that kind of thing than your average homeowner. And, I think if all loans were non-recourse, I don't know that we would have ever had a bubble like this and put all these folks in this position, and I think we'd have higher homeownership rates than ever. I don't know that we have to give up this goal of high ownership rates, right? I just think we have to give up doing it with cheap financing that allows people to buy more house than they can afford.
Okay.
Bruce?
Yes.
One point I would certainly like to make, I was visiting with Sarah about that. I think she was surprised. Traditionally at auction, forever, and even today, at least 75 or 80% of the people that buy a home at auction live in it. People are under the perception that the people that buy homes at auctions are investors. And only when the house is almost a disaster and the private individual cannot figure out a way to finance the repairs. But most all homes, that has been forever. That's something, you have well-conducted auctions that are well-marketed, you'll find that the people in the neighborhood absolutely are going to be there, they're going to buy them, and they're going to give fair value. And they're not, that's the thing I harp on all the time. It's not that you have bought it under the market. You will find they sometimes pay above the market. Just as likely at auction that they pay above market as below. I've always said, if you break it out into percentages, people that have good judgment would say out of every 10 homes, 1 sold a little too high, 1 a little too cheap, and 8 of them dead on. The only thing is, nobody knows how that breaks out. Mm-hmm. But you can see, in general, they bring exactly what these folks right here would say they were worth. Not what they would buy them for, but what they would say they were worth.
Now, home investors don't steal value, which I think is government's perception. They add value. Right? They come in, they fix things up, they take care of title problems, they take care of other stuff. They're adding value, not stealing value.
Well, especially when we turn around and, if you saw pictures of our rehabs where, you put granite in the kitchens and the bathrooms and it looks fantastic and it really represents the highest comp, which affects the next REO, what you're likely to get. So, no, we are a partner in this. We're also, what we're forced to do right now is basically flip houses because we don't have the financing to keep them. This audience here, we're able to have a loan program, and if I could fund it with $100 million, I would do $100 million of loan business next year and charge 9.9% interest, and we go through the money millions of dollars at a time because it still provides a cash flow that makes sense. If we had financing that was 5%, my gosh, we would be able to take the properties and keep them off of the market. And that's one of the things, as soon as we buy a house and fix it, that same house reemerges because we have no other choice. But if we did, you'd have inventory that would be resolved and permanently kept and wealth created for people. And I think that would be good.
So when you said flip houses, did you mean that you buy it, you rehab it, and you resell it to an occupant? All right. But what percentage honestly happens where you buy a huge pool and then you sell it, you buy it for a large discount because it was a competitive bidding process, you got a really big discount on it, and then but you sell it immediately to somebody else because you can you can make a tiny margin on it.
Zero in this world.
Zero in this market.
In this room.
Okay.
Rather, in this room.
Yeah.
It's not that we would be, and I don't even find fault with that. I see that a society doesn't benefit as much. I really do. There's times where investors just show up and we're the easiest person. Let's say you have 3 fallouts and you have damage being done to a property, and some investor comes up and says, I'm just going to take this off of your plate. And what if we didn't do anything to it, but we just sold it to someone else because we had a longer marketing time? There shouldn't be anything wrong with that either, because we've had an easier sale for the owner than we had. But typically, no, we're repairing these properties to a great extent. And one of the things that's been very difficult in the appraisal world is when we had 70% of it being lender owned, we'd be the only house that was a comp that had a kitchen. And it was a little hard to explain. Well, why would somebody buy yours for $140 when they could buy the same square footage for $78? Well, did you go inside that? It doesn't have a house. There's nothing left. But the appraisal world really had a hard time because they didn't have a model match repaired house or a substitute property. And that's really where, some of the breakdown happened. As a matter of fact, it shifted our complete business model. Here's a perfect example, and this is what was going on, let's say, earlier last year. We bought a property, it sold for $350, we bought it for $50. It needed a lot of work. We put $28,000 of work into the property, so we're into it at $78,000. We listed it for $120. We had multiple offers up to $123 within 2 days. It got appraised for $100,000, review appraised for $78,000. And when you looked at the interest rate and attached it to the $78,000 number, and by the way, I said, forget it, we'll just rent it. It rented for $1,150, but what's the payment at 5% and $78,000? It's half a rent. So honestly, what the appraisal world was saying at that moment was ownership is worth half of the rental value of a property. And that's where we said, finally, okay, we're not going to fight that. We're going to have to go buy inventory that literally doesn't have the REO as the competitor constantly. So that was a problem for us, yes.
But I would like to say both to Freddie and Fannie, and I would love for you to just try this experiment one time. When you go through the tiered process that you're talking about, and now you're finally down to the level that you're going to sell them in a pool, hire a reputable auction company, not necessarily Williams & Williams, but hire a reputable auction company and make it that they sell absolutely without reserve on all 300. And I will guarantee you that you'll net more money than what you're getting right now. I would bet my life on it. Take me up on it. That's all right.
You know, the one thing you have to admire about Tommy, Tommy's bought and sold a lot of properties. And how do you market every one of them?
I have never sold a house myself or anybody in my family that didn't sell at absolute auction in 40 years.
Absolute auction.
That's a fact.
Which means you can't say no to the final answer.
That means you sell it.
I bet you do. I know you do a good job anyway, but boy, that absolute word really changes the game.
You bet your life.
Okay. The way that I look at, let's say you do have a group of people making payments on houses that are over encumbered. I think the best way to solve all this problem is find a way to naturally get the prices back to a better level. Right now, we have no way a construction company can do anything. Because one of the things that's happening this time that's different than last time is the age of the inventory we're foreclosing on. When you look at the foreclosure list in Riverside, it's about 45% 2000 or newer inventory. And it's going for a lot less than the builders could ever build it for. So I guess one of the important questions of this evening, and I probably wouldn't mind most of us answering it, is what do you think is the best thing we can do to inflate prices in a natural way back to a reasonable number? You're confused by the question.
Yeah, I think they're reasonable right now. I don't think they're undervalued as much as you think.
Could a builder build a house?
I think probably with more ability than you think. I've seen these numbers on cost of building, and you know the problem is they're using cost of materials, cost of labor, cost of land. That was equivalent for 2006. You start putting in proper cost of land and stuff, and the numbers aren't quite as unequal as you think.
We've got builders that are building today.
Yeah.
On land they created lots on now?
No, that land they bought today.
Land? Okay.
Lots they bought today.
Okay.
And labor costs that they're paying today.
Yes.
And yes, they can create that house at that 150 level, 250, whatever that level is, and that's market.
Yeah,
so the cost to build and the value of the property are the same.
Well, wait a minute. But the land, you said, they didn't create the lot. They bought a lot that existed?
Yeah.
Okay, well, that's very different than the cost of creating a lot. That cost
Except the cost to create that lot in 2005, you're paying a premium on ag dirt that never had a value agriculture-wise more than a couple $1,000s an acre. They were paying $100,000 an acre or $200,000 an acre or whatever the number was, and that was the inflated price. But it wasn't ever worth that.
Right. There's some infrastructure costs that aren't going to disappear.
That's true.
So, I mean, what does it cost to put up a building lot if they gave you a hill for free? I think you'd be in there for 50 grand.
I understand that there's more slack in the system than you think, and people can make ends meet if they want. It's not, the prices are not that undervalued in California right now. No way.
Okay, Christopher, if builders could build for a profit and create land, I could create lots and do it, you'd better believe they'd be doing it.
If there was someone to buy it, they probably would be.
Oh, no.
But there's not much demand.
Oh, that's...
And demand is completely satiated by the current stock of foreclosed units.
No. We fix houses and sell them for retail. Our pending time, our average pending time in days is 12. That's how long it takes us to go pending with a fully fixed retail house. And it's because there's no inventory. When we put a house up for sale, it's looked at instantly because of the inventory. It's artificially low. So that's what I'm telling you. If builders could build houses and at the numbers that made sense, they'd have an audience that would take them, but they can't. I don't see how they can compete at this level.
California Association of Realtors disagree with you because their inventory numbers don't show that.
Well, they can't disagree with me because it's my business model. I can tell you that that's a fact.
All right.
No, what are you saying?
Maybe it's just you, Bruce.
No. What are you saying? That there's...
Their estimate of units on the market right now relative to sales is not as high as it was a year and a half ago, but it's still high. And that's true in the U.S. overall as well.
Well, you just lost, let's say you lost 25% of the volume, right? Your sales went down. That calculates into a lot more months of inventory, just that
There you go.
part of the equation.
Okay.
The numbers for sale didn't change, but I understand what you're saying. I do, but I don't see how builders compete at these levels. And I guess that's, how do you have an economy of California come back if you don't have construction? Can you do that?
Construction's not that big a part of the economy. It's big, but it's not that big. Construction's not that big a part of the economy. 5-6% max.
I think Dan hit upon one of the critical pieces. The land was way over-evaluated back when those homes were built that you're talking about. Way over-evaluated. Now that it's come down to reality, and Joe, tell him before we started, Joe, just tell him what the difference is. And you told me that before we started. Listen to this.
Yeah. We had land purchased for development was entitled but without utilities in the roads at about 40 to 50,000 an acre. You can buy all that you want right now for 5,000. We're seeing about a 75 to 80% discount on finished lots, and my firm does a lot of market analysis. We're helping dispose of a lot of land and finished lots. And we're seeing 70, 80% discounts. So
70, 80% discounts off of replacement cost?
No, this is off the land price with the finished lots we're selling for.
Okay.
Not with a house on it, but a finished lot that was 100, you could buy that for under 20,000.
Sure.
So that makes that margin for a developer can come in if they put the right house on there, and people want smaller homes today. So if you're not building 2,400 to 3,000 square foot, you come down to 1,400 to 1,700 square feet, and you have a $10,000 lot. Look, I've got a guy that'll buy all we can find for him, and he's just warehousing it because the cost to develop it is probably $30,000 a lot, and the developer's already paid the impact fees to the municipality, which might be another $15,000. So they can buy everything done for $10,000, $15,000, no more than $20,000 on the very best lots.
I completely agree with that, and I bought nearly 100 lots in the last downturn for nothing, and I like that model. But I couldn't have created those lots for what I paid for them, and I had to hold those lots for about 5 years before they'd even pencil. And I bought them in California, and they cost me $3,000, and they were already graded, and streets were in. So there's times where you just don't have much to do. So does no one agree with me that prices need to go up to solve this, or it can stay right where they are?
In that same area, there's been in DeKalb County in Illinois, they had one building sit in one building permit in the last year, and several of the others, 6 or 7 or 3. In these, maybe out of 200 lots, they had three buildings. But they're just land banking because they can buy them so reasonable.
Sure.
And when the market does come back, and it will,
sure, it will.
They'll be prepared to go into action really quick, and they'll have a huge profit margin when it happens.
Sure.
Well, I would argue that you're more right in Riverside and San Bernardino than you are in the rest of the state.
Okay.
You go out to Los Angeles, you go to Orange County, you go to San Diego, anywhere in the coastal areas, prices haven't come down nearly as much as I expected they would. In fact, I'm surprised by the resiliency of home prices in the western part of the state. Out here, you could say, yeah, they maybe overshot just a little bit, but then again, out here is where they have the biggest inventory problem as well. You still got lots of empty homes out in different parts where they're still trying to get rid of some of these inventories. Even the inventories of lots they have to be built on and get rid of. Once that all gets caught up, yeah, there's going to be a bit of a bounce. Even in San Bernardino, prices have bounced. Median prices have bounced about 10, 11% year over year. And that's, they're moving up towards a probably more stable thing. So
it's bouncing because you have an artificially low level of inventory. That would be my opinion. I mean, if you let inventory occur, then you'd have a problem. I've heard. Let me just, and then I want you to comment on this. I've heard and I've met with Carr and talked with the people at Carr as far as in a small meeting, and there's some thinking there that there's pent-up demand on the sidelines as buyers. I just can't buy that. When I look at the delinquency rate and I say, okay, that eliminates that buyer, and the foreclosure rate, and the unemployment rate, and the underemployment rate, where are all these buyers hiding? And then you've got all these people that are upside down that are stuck. I just don't see who the next buyer is. So you've got a dilemma. You've got all this inventory that would really like to come out, and I don't know who's the recipient. And I think if you just flood this market, what happened in '08 would happen again. You'd end up with a price decline that would be significant, or you'd have to let investors take it off the shelf and keep it on the sidelines, would be my feeling.
But you're making it into sort of a discrete episode. And they take San Bernardino, and prices did overshoot down there. And when I say overshoot, what I'm talking about is what these gentlemen said before, which is in the long run, prices for homes are determined by incomes and interest rates. And if you look at the long-run relationship between home prices and incomes, accounting for interest rates, in San Bernardino, prices shot the way down. And what did you see? Well, as soon as that happened, there is a residual demand there. But for that residual demand to come out, they got to have low prices. So every time those prices come down a little bit, you unleash the demand. It stabilizes, push it up a little bit. Maybe they get pushed out a little bit. They're not going to go much lower. Prices go down 15%, and there is going to be a whole bunch. All that residual demand they're talking about will come out of the woodwork.
This belief that we can't have a flood of foreclosures because it'll drive prices down, I think's hogwash.
Well, I think it's going to be absorbed by somebody other than an owner-occupant.
Well, that's fine. We've got a lot of folks that got to become renters as part of this process.
I know you just said, now there was an article that I did read. You believe foreclosures don't cause
price declines.
Okay.
Yeah, price declines. I agree with that. Price
Okay.
declines cause foreclosures. Foreclosures don't cause price declines.
Do forced sales cause price declines? That's almost the same verbiage.
No, because, once you hit a price level that there's demand for, right, you find competition. Look at what happened when we got prices starting to go too low because there was a flood of foreclosures, right? Start to get a few deals, and suddenly you had 20 offers on every house, and they went back to market immediately.
Okay, in 2008, when we bought that house for $50,000, we bought that house for $50,000 because we were not only the highest offer, we were the only offer at 15 cents on the dollar of what was formerly there. That wasn't market value, and the reason it was $50,000 is because when you pulled up 0 to 50 or 0 to 100 grand in Moreno Valley, there were 500 properties for sale. Right now, there's 42. So you had a glut of have-to-sell properties, and the price was falling. There wasn't enough people to take them, and they kept saying, what's the next low price? I don't know why the thing would be different, Sean. I don't know if you gave Moreno Valley 500 properties.
It did correct.
So it did correct. Yeah, within a year, prices bounced back up again. You were happy to be first, and you made a great deal. Congratulations. Yeah. You're part of the solution.
It corrected. Okay, but what if you had kept that inventory at 500? You don't think there would be...
It stayed at 500 because somebody would have come in. More would have come in.
Once you...
Back to your how did it get to 400
to 500?
Go ahead, I'm sorry.
Go ahead.
Bruce, one of the comments I've made to you before, we sell homes in at least 40 states every month. And homes that sell from 75 to 150,000 have stabilized, and they might have actually gotten stronger.
Okay.
Homes that were priced from 225,000 on up, there's no bottom to them, because the people that can afford to buy and want to buy today, they are in that level. When you hit 150, 175, you've maxed out their ability. It doesn't make any difference if you have $1 million home to sell them. Their ability to buy is 175, and that's all they can give. And I, of course, keep belaboring this point, but California, you have a very unique circumstance out here. You don't realize what the rest of the United States is about. We don't have homes that are about as big as 1,400 square feet that we ever thought were worth $500,000. I'm here to tell you that is the facts. See, now when you go to states like Florida and Georgia, I'm talking states that have very strong, well, I won't say that about Florida, by the way, But Georgia is certainly a very viable economy. Both of the Carolinas are very viable economy. But when you go out there and you try to sell homes that cost $300,000, $400,000, $500,000, $600,000, you're in for a disaster because there isn't any player. And that's the thing that we have to focus on, is that we have priced ourselves. In other words, if the market was for Chevrolets and you kept building Cadillacs, you're in big trouble. And General Motors proved it.
Sean, kind of a diversion. I just wanted to ask, because of something that he said, the coast and all that. Are you seeing more in your records? Are you seeing more high dollar foreclosures? Do you think that area is going to be hit harder or not?
I mean, they're growing faster as a percentage, on a percentage basis, than other groups. However, they're still a very small fraction of the properties that are making it through to foreclosures. I mean, my cynical view, which you probably caught on to by now, is that those are where the biggest losses lie. And so if you're in a position where you're not forced to take a loss,
You're talking about the lender now, or the person?
lenders, yeah.
Okay.
I mean, we see the low end stuff gets pushed right through because the losses are smaller. The higher end stuff, the delinquency rates are still there, but it's not getting pushed through to foreclosure at the same rate.
They want to keep the houses in Malibu for, bank parties.
She did get fired.
The current loan mod programs, anybody feedback on that?
Well, let me just I think at the end of the day, this notion, especially here in California, where we have non-recourse first money loans, right? I think it's a pretty fair deal that you get to buy a house. If it doesn't work out, it goes, to be less. You get to walk away, and as part of that, you have to move, and you get a 7-year hit on your credit. That's a pretty great deal for homeowners, right? And why force lenders to do, I don't understand what we're trying to accomplish there, where we give the person back less. The lender made a mistake making that big a loan. The homeowner made a mistake buying that big. The consequences are clear, right? You're going to lose the house either through a short sale, which I think makes a lot more sense than a foreclosure, right? Or foreclosure, so move on with that. I think, loan modifications that don't include principal balance reductions or more extend and pretend, those are all going to blow up, 4 or 5 years from now, and just make sure we're in this mess for longer, create greater uncertainty about where the bottom really is. We need some certainty in the market, and I don't think they help. Principal balance reduction, I think it's a bad lesson in the moral hazard realm to say you get to make a mistake, and oh, by the way, and guess what? The next door neighbor who paid 100% for his house or put a huge down payment is going to be pretty angry, and I think more angry than politicians are ready to deal with.
Well, it's funny, they've been angry all along. It's amazing they keep pushing these programs forward because they've done poll after poll after poll, and the vast majority of Americans do not think these folks will be rescued. So why they keep slamming it down our throats, I can't figure it out, but Washington, D.C. works in mysterious ways.
Bruce, excuse for extend and pretend.
Yes. I do have a real simple answer for this one.
Okay.
You have talked about helping your daughter this year buy a house.
Yeah.
Now, let's use this scenario. Let's say your daughter bought a house for $300,000 3 years ago. And now she comes to you and she says, Dad, I've just talked to the mortgage company and they're willing to write it down for $225,000. And you do the research and you say, but what's her name?
Sarah.
Sarah, I've looked over and the homes in your community are worth $150,000. What would you tell your daughter?
What would I tell my daughter?
Yes.
Buy another one and wait them both out.
Oh, buy another one and wait.
Yeah, on the average, it'll work out just fine.
She's going to have to borrow the money from Dad.
I don't think you can wait this one out.
You can leverage your way into insignificant amounts, though. I mean, honestly, you can.
Right.
Okay. What about short sales? Now, do you see that they're going to start taking a fair amount of inventory out before the trustee sale process?
I mean, I think short sales make a ton of sense. It allows the folks to leave with a little more dignity. There's a sign, nobody knows whether or not it was a foreclosure or not. I mean, and it creates a market sale. I think we should see more short sales. It creates also additional, income and for realtors and title companies and all that kind of stuff, which I don't think is bad for the economy. So I think short sales probably make more sense than letting these things make it through to trustee sale. But no, I don't think we're going to see them ramp significantly. And I just come back to my thesis that they really can't afford to take all these losses at this time and, or push all this inventory through. And we're going to extend and pretend, and we're going to do it for years to come.
Yeah, it's with the policies that are in Fannie and Freddie certainly seem to have increased their efforts to make those happen. But one of the things that's frustrating, and it gets back to how come it takes so long? That's an interesting journey. It takes, a lot of people in here are waiting sometimes for 6 to 12 months for a decision. So it is hard to believe somebody actually wants to happen very fast. Sean, on the opening bid side, because I think lenders, it's been a learning process. Lenders have certainly gone through and said, okay, how do we lose the least money? Because they all want to do that. And short sales would be one, and lowering the bid at the auction, if you will, at the trust. Has that been pretty level in the last couple of years as far as quantity?
Yeah, I mean, we definitely saw, in 2007, you couldn't buy really anything at the trustee sales because the banks weren't discounting. And those investors that are down at the trustee sales, we all live at the pleasure of the bank and the discount they're willing to give on the opening bid. 2008, great year. 2009, boy, the margins started to get really tight, and beginning of this year, super tight, to the point where, guys that are buying 50 properties a month are saying, I don't, I'm thinking about shutting down. We're seeing them now with housing getting a little tough. They're loosening up a little bit in terms of the ones that investors actually purchase at auction. But, the margins, when I learned to do the business, I was kind of taught, you want 30 to 40% below market value. We've seen an average closer to, 17, 18, 19 this year. It doesn't leave much when you think about the sales costs and all the rest, and the investor having to fix those properties up, evict the tenants and all the rest. I certainly don't think most government agencies could do it that cost effectively. So I think we have a very efficient group there. I think if lenders wanted to see higher returns, they'd post those opening bids earlier.
Absolutely.
You post them 5 days ahead of time, you're going to eliminate a lot of risk for the buyers down there at the auction. The biggest problem that a trustee sale buyer has right now is you don't know which properties to research. A friend mentioned a property that came to sale, probably a typo or reversed, for $17,000, but it was announced at the sale. Nobody had done research on the property, so it only got bid up to $50,000. Should have probably gotten bid up to $80,000, but it was only announced a second before. Nobody had time to go look at the property, do title research, do all of those things that would have led to an efficient process. We have plenty of folks down at the trustee sales right now. You give them that opening bid information a week earlier, you're going to see a very efficient market down there. It's not going to be the margins that we had in 2008 where guys are making 50% annualized returns, but it's a very efficient market.
Have you ever talked to the lenders? Not that I want them to improve their methods, I really don't. But have you asked?
Of course you do. You're a taxpayer.
I make more when they make a mistake, though.
We did a trial where from one lender, we actually got opening bids 5 days early, and we saw the average discount on those properties. And at the time, the average discount was about 25%. We saw the average discount on those properties where we posted it 5 days early go to 15%, which, when you factor in eviction, repairs, sales costs, and all the rest, that's an extremely efficient market. Not the margins that my folks have been used to, but some of these guys are very efficient at clearing these properties and doing it quickly.
One of the things that happens, and you're dealing with it when you foreclose on a house now more often, and when we buy a house at trustee sale, is it's occupied by someone with an attitude that they deserve a lot of stuff still, including your doors, or whatever they can take. I guess I just want get some feedback if that's a common experience now with people that are dealing with anything that's occupied, is that somebody's been taught that they have, not only do they have more rights probably than we do for a while, but they actually deserve an ever-increasing amount for cash for keys. And I just wonder, just mentally if that's not going to do some damage to us later on.
Well, of course, we sell homes constantly that have been through the foreclosure process. And without question, you see, in other words, in 2010 compared to 2009 or backwards, more and more homes that have been basically almost destroyed by the last tenant or owner, because I think it's strictly an emotional thing. They're just plain mad. I don't think they think so much that they're entitled as they're just mad, and they want to show you that, yes, we'll just tear it up. There's, if you would look back 10 years ago, that would almost be unheard of. And now it's commonplace. They've tore out the air conditioner. They've maybe even taken out the electricity, the copper wiring out of the walls, taken out the doors. It went just to maliciously destroy it for really no monetary gain. But obviously, it's an emotional thing.
I read a quote the other day. Quote said something along the lines of, "Our society is doomed because the youth of today have no morals, no respect for their elders, and no respect for education." And this, of course, was Socrates who said this. So, I think the claim that the world's going to hell in a handbasket is often a little bit overblown.
On the non-recourse thing, non-recourse loans in California, there's an exception for the non-recourse, and that's waste. If you commit waste against the property, stealing those doors, stealing those things, the loan turns into a full recourse loan. So you're not just liable for the losses of the doors, but for all of the losses. And I would sure like to see some public statements that came out and said, instead of, hey, we're going to go after strategic defaulters, hey, we're going to go after you if you commit waste on a property. There's no reason that these homes should be getting destroyed and damaged.
You sue the people who have money. Strategic defaulters have cash. They're worth going after. The people stealing the sinks, they don't. You're not going to get blood from a rock. These folks don't have anything to get. What are you going to get out of them?
You're not really going to go in California. How are you going to come after?
What are you going to get?
How are you going to go after a strategic defaulter on a non-recourse loan in California? You can't do that either.
But again, I think, honestly speaking, I don't like the fact people are destroying their houses, but I think pursuing them legally is a waste of time and money. I don't think that's going to help anybody.
I think the Fed, the government, one of their things that they have is a bully pulpit, right? What you actually do and what you say you're going to do, I think, are two different things. And I think the federal government is really good at saying they're going to do things versus actually doing things.
I just thought it was part of our recycling culture.
You're right, recycling, I think they ought to go to jail, to be quite honest with you.
Yeah.
That creates a problem.
When you're on the front lines and you see what's done with impunity, because they literally don't think anybody will do anything at all. We actually had... we just bought a half-acre property in Temecula where a guy just took a saw and sliced off the fence and called the police, and their question was, did we see him do it? And when they got away with that, they literally dismantled the house, and we're 45 grand later. And we can sue somebody with no money. But, if there was some teeth saying, that's just not right, that wouldn't be bad, actually. That would maybe put some teeth behind it. We're kind of closing in on the end of the evening. I wanted to ask one other, this is not necessarily a question everybody's going to understand, but this idea of MERS. Christopher, are you familiar with that term at all? Okay. I know that Sean is. This is going to become an issue. If it's not touched somebody in this room already, it's going to. And MERS is an electronic system that tracked ownership of notes. So if you bought a trust deed from me, usually we would do an assignment, and you would have a recorded copy of that assignment, and you could prove that you were owner of the note. MERS was an electronic system for that. And when they sold notes, sometimes it was over and over and over again. And so somebody doesn't get paid on that note, they go to foreclose it, and there's definitely states now that go, okay, well, where's the original note? And you've got 10 lenders that are out of business in between an assignment and the end foreclosure, and now you're having courts go, without the paperwork, you can forget it. So it's now starting to happen in California that people are buying at trustee sales, and they're being challenged for their right to own the property, and you have a free and clear property at that point. So it's quite a problem. So just be aware that that's an issue we probably need to become more familiar with, because it's going to raise its head, and it's probably going to get to a point where it's going to have to be dealt with at a national level, because there are people right now that are ending up with homes free and clear. That's happening in Florida, and it's starting to be certainly attempted a lot in California. So has anybody else heard that?
Well, one of the things that we're seeing, of course, you get a more educated defaulter than ever before because of the internet and the training and the various things that you can get information on.
Very true.
So that world is flat is happening in the default world too.
Okay. So the information travels very quickly. Well, that's true. I typed in MERS, and I have a 50-page report on my desk on court cases and everything. So, Sean, we talked about it in the limo on the way over. Have you had investors come to you and say, I've got this problem?
Yeah, I mean, there's a number of things there that are happening, and the MERS thing has definitely been a problem. There are some of these paperwork issues that we face. MERS is one of them, where people will come back and sue. Another one is a HELOC gets reconveyed, gets paid off. The title company sends the check, to the lender that made the HELOC. But the HELOC stays there. The homeowners now left that house in a new house, and they go back and take a loan or take money back out of that HELOC because the lender's still sending them the checks. And now you've got this big HELOC, and you come in there as a trustee sale buyer, and this HELOC that shows on the thing as being, or you do believe would be reconveyed, was actually never reconveyed, and you've got this huge debt that you weren't expecting. So there's definitely some landmines out there at the trustee sale steps. I mean, you got to be careful.
Well, the REOs are not exempt from the MERS issue. You just have one other level of problem.
Right, absolutely.
Yeah, so for our industry, that's a big thing coming up. And title insurance, as you know, when you buy a trustee sales, isn't readily available, as in not available, and so.
I think it's just dangerous. We play with. Our country is great because we have the rule of law. Right, and I think that there's some basic things there. And when we start playing, some of these games over technicalities, which I think the MERS thing is, right? The person clearly borrowed the money. In the past, you just do a lost note affidavit to clean those things up, and now we're saying, well, maybe not. I think we need that settled quickly. I'd love to see that run through the court system and get an answer soon. Because if you lose the paper note, do you really lose all your money? I think people would be a lot more careful with the piece of papers that they did trustees' deeds on.
I guess so. But
trust deeds on.
Unfortunately, the problem is already in place. There's probably several $1 trillion of who knows who's got that piece of paper.
Seems like a question we need to resolve.
Yeah, it sure does. Okay. Start with Christopher and just come down the line. What ideas do you have that you'd like to see the real estate industry implement to get back on its feet, or any kind of prediction that you see that?
I think at this point in time, we have done more than we need to do, and we just need to sit in our hands and let this thing burn off.
Now
Stop messing with it. Because every time they start doing policy stuff and they start jerking sales around, start jerking prices around, they're creating more uncertainty and they're not helping the situation. Let it go. It'll work its way out of the system. It always has before. The world has a self-righting mechanism, and we just need to let that take its course.
Okay. Joseph, any?
I would agree with him. It's a surprise to you probably, but the supply and demand need to be market forces and not artificially influenced by the government until they quit creating this borrowing future supply by their subsidy programs they're putting out. I know that helps reduce some inventory, but it really messes up the market because it needs to seek its own level, and prices will seek that level, and then there'll be buyers and there'll be sellers, and we'll get going. But as long as the government stays involved, it's going to be very difficult to see any kind of recovery. And especially on some of the graphs you had for 2012, well, that was on the commercial side, that were the loans that were made with a 5-year balloon in 2007, but 2014 has the same problem because a lot of them had 7-year balloons. So we still have some significant economic challenges ahead of us here. So I would think the best policy would be to leave that alone, let the market seek it, quit pretending. Let's take our losses, redeploy the capital, the world will be a better place.
Okay. Tommy, any?
I think this is the same, proposal I've made every time I'm here, so I'll make it one more time. I think that the minute that there is a foreclosure, in other words, when a house is going to actually go through what you all talk about, trustee sale, that instead of that process happening in a courthouse situation, which in no way creates market value, that you immediately go to the lawn of that house with a reputable auction company, as I've said, and you sell that house well marketed with a well-conducted auction that day, right now. Then you stop all of the, what I call monies that are going nowhere and accomplishing absolutely nothing. Now, whether it's Fannie Mae or First Bank, if they want to be there and they say, when they look at that house, we would rather have this house for $90,000 than to let that gentleman buy it for $87,500, trucked right on. And they'll find out whether they're right or wrong.
Okay. Absolute auctions every time?
Absolutely.
Okay.
And of course, that's with the lender with the right to bid. But what you all understand at trustee sale, it doesn't happen that way at all. An attorney comes in at a trustee sale, he has a number written down because the lender told him, this is what I have against the property, has absolutely nothing to do with its value. If he was standing there looking at it, if the lender was standing there looking at it, they'd say, yes, we loaned $150,000 on it, but it's worth $35,000 today, and that's too bad. And that's the time to deal with it, rather than to send it down this endless cycle of throwing money against the wall and accomplishing nothing.
All right, Tommy, thank you. Sean?
You know, I think the main thing I worry about is the unintended consequences of some of the government stimulus I still believe we have in housing, specifically low interest rates. You know, the pension thing came up a number of times, but we've got an aging population of baby boomers who are getting close to retirement. And if they've done a good job and saved some money, they need to get a decent return on investment. And it's hard to do today when you have artificially low interest rates.
I have a 9% trustee that works good.
Well, absolutely. So, I mean, I think ultimately, I don't know that we're doing ourselves any favor by going through this extend and pretend process versus letting the market clear, getting back to market interest rates that don't require Fannie and Freddie to make every loan, let you make loans and let other private individuals make loans and let the market clear. And I think the less intervention, the better. Still in a well-announced, well-organized plan so that people can have some certainty. Right now, everybody's worried about theories of shadow inventory and other things we don't know. And the market can't have a bottom. The market can't improve until we have some certainty.
Very good.
I think we've got Dodd-Frank that we're going to have to deal with in both the commercial side and the residential side. It's a lot more regulation that's coming down. And we still haven't figured, we're going to have to figure out what to do with that. I think that we have to force some of our financial institutions to deal with the problems they have rather than pushing them on down the road. Because as long as those get extended, as long as those get pushed down the road, we're not going to recover. We're just going to be in this doldrum for quite some time. And the debts that are coming through on the CMBS from 2012 through 2017 aren't going to be able to get dealt with because we haven't dealt with value, because we haven't dealt with those problems that are sitting there. So we got to deal with those. The sooner we deal with them, the sooner we're going to be able to recover.
Well, we have low interest rates, low home prices, but we're facing really slow sales. So it's sort of an illogical situation that we're facing. But I'm not in favor of, and this is just my personal opinion, but I feel like the homebuyer tax credit did create a blip, and there's some unintended consequences from that. So I'm not really in favor of something like that to accelerate sales again. So I wish everybody could focus on efficiently getting more homes through the process that's inevitable for many of the homes, and then let market forces, dictate the sales price, and just to introduce as many efficiencies as we can if that's possible.
Okay. And Peter.
I don't know if you'll be able to have Sarah and I back next year. Who knows where we'll be.
That's right.
The whales are migrating. But I think that the banks should step up and follow the guides with regard to foreclosures and move the properties through and get on with it.
Yeah.
I want to thank all of you. It's been quite a challenge of being up here, trying to think of good questions and feed off of your tremendous answers. There's, I don't know, never been a better panel than I've ever been able to question. I really appreciate all of your input and insight. And thank you all for joining us and making I Survive Real Estate 2010 a very memorable event. Thanks again.